It seems like everybody is waiting for Fed Chair Jerome Powell, Papa Powell, to announce that rate cut. Come on, Jay Powell, let's do it, buddy. Most of us think this could be the final push needed to take us to the next and probably final phase of the bull market. With several indicators flashing red on a potential recession, it is, of course, prudent for the Fed to cut rates. But will the outcome be what we actually hope for? Will it be what we're anticipating, the final mega rally in the market? Well, let's find out together. And at the end of the video, I'll let you know my plans. Now, analysts predict a rate cut should be expected by September, possibly sooner. Emergency rate cuts, we'll see, but definitely in September. Market is basically thinking 100% it's coming. Fed Chair Jerome Powell himself said that the time for a rate cut is approaching, and if we get the data we hope that we get, then reduction of our policy rate could be on the table at the September meeting. With the prediction markets basically putting that 100%, the only real difference is going to be the 25, 50, or 75 basis point cut. This means, of course, that the possibility of a rate cut is increasing massively as inflation rate comes closer to the Fed's 2% target. Now, according to analysts, the recent market dump, which was triggered by mounting evidence that the market is not as rosy as advertised, increased the chances of a rate cut happening to an almost certainty. In case you missed it, the SAHM rule indicator just flashed. It's a basically 100% accurate indicator that monitors unemployment data, although the founder of that rule did say, maybe it's a false positive this time, so take it with a grain of salt. If you want to know more about the rule, link down below. You can watch that video to learn more about it. Now, to avert a disaster, Wall Street analysts now forecast a series of rate cuts starting September and continuing into 2025. Not only that, Wall Street's also predicting that the Fed will have to slash borrowing costs in its November and December meetings. The majority believes that we will have a benchmark rate of 4 to 4.25% by the end of the year. That is a 1.25 percentage point lower than the prevailing rate of 5.5% right now, which is also at a 23-year high. And it might come sooner, according to some analysts. The FOMC, or Federal Open Market Committee, does not need to have a meeting before it announces a rate cut. They can just cut. There are several instances where the Federal Reserve has actually initiated a rate cut between meetings. So this is done when the Fed thinks the economy is headed for a recession. For example, the last time it happened was in 2020 when the pandemic shut down the economy. Before this, the Fed initiated an emergency rate cut during the global financial crisis in January 2008. So emergency cuts, not awesome. You want to have a as scheduled cut. Anyway, before this, there was an emergency cut as well in 9/11. Now, this idea here is supported by JP Morgan's chief economist, Michael Ferroli. He said that there is a strong case to act before September, that maybe we don't need to have one of these tragic events happening. Maybe, just maybe, you cut before September to avoid the worst happening. Maybe September is going to be too late. Now, before we get into the rest of this and how, of course, it could affect you or why it might be wrong, I want to let you know about the Wealth Mastery newsletter. This is your weekly guide to the cryptocurrency market. Now, our readers love it. I'm sure you will too. Here's why. Every week, my team of researchers and I help you not just stay ahead of the curve, but also to save your time by finding you the latest and greatest insights on altcoins, meme coins, DeFi, airdrops, charts, and much, much more. You can join our 140,000 plus weekly readers for free. Link in the description or the pinned comment over on X. So before we continue down this rabbit hole, let's just review why a rate cut is good. In a nutshell, lower rates make for borrowing money cheaper, meaning more economic activity, right? It encourages companies and investors to borrow for business expansion or to invest in stocks and crypto or real estate or whatever else it might be, or just for homeowners, even to be able to buy a house, right? For the longest time, the Fed has maintained a policy of higher interest rates for longer. We've been stuck in the 5.25 to 5.5% rate hike area since July 2023. Crazy. Now, take note of that date for later, by the way. Higher interest rate is also imposed by central banks, primarily to cool down an overheating economy and to lower inflation down, which has largely done up to this point. It's a delicate balancing act, though. Do it too hard, too long, too fast, you get a recession. If the interest rates are left too high for too long, economy slows down too much, the economy contracts. If it contracts too much, recession, pulling of hair, gnashing of teeth, bad times ahead. We also have to take note here that the result of rate hikes can take a while to actually affect the economy. Now, this begs the question, was the high interest rate left too high for too long? Will the expected positive effect of the expected cuts be overrated? This is the chart going around the internet right now saying the majority of the decline in bear markets occurred after the Fed's pivot. That's bad news bears, right? The original chart was from a Reddit thread a couple of years ago titled Fed Pivots Don't Mean a Bull Market. Of course, some analysts are saying that this is not the right way to be looking at it because another chart was shared over on Twitter, which shows that equities tend to rally after the Fed starts to cut. Can we just, I know these are conflicting ideas, but maybe the next chart will give us a little more clarity as to what the heck is actually going on here. TLDR. It depends on if we get a recession or not. If there is no recession, when the rate cuts come, then boom, yeah, baby, long you're long. Let's go, because the market will probably pump. If we do get a recession, then say goodnight for a while and hope that you've taken enough profits off the table to survive the bear market. So, which is which? Look, I don't have the answer, but we can look at some indicators and try to decide for ourselves, right? Remember, no one's got a crystal ball. No one knows when the recession is going to come. Recessions always come, but when and how bad is always the question. Now, earlier in this video, I said to remember the date of the last Fed hike. Data would suggest that a recession tends to happen 6 to 18 months after the last Fed hike. If this holds true, then a recession will happen potentially before the end of the year or maybe sometime early next year. We also have the SAHM rule, which is a lagging indicator. It signals if a recession is actually in progress already, but just hasn't been officially announced. But there was one time it was a leading indicator where in the recession happened months after it flashed, about 5 months or so. Maybe it's a leading indicator this time. And again, late Q4, sometime Q1, recession happens. We also have the super accurate inverted yield curve. It's about to uninvert. So there is a big chance that a recession could happen once that does uninvert within 6 months on average. Again, end of this year, early next year. But Lark, the GDP is still good, didn't you see? Plus lower rates means more money for the market. So we're fine. All that stuff's bullshit. Well, I hope so. I read this somewhere and I agree with this analysis. The cause and effect are actually reversed. The Fed pivots when the economy is already going down. And by the time it acts, the market's already in free fall. So there's a chance that when we hear the rate cuts are happening, the economy is already in the crapper. So what now? What now? Well, obviously not financial advice. You guys have to make your own decisions. I try to provide the information. You have to decide what to do with it. But this is what I'll be doing with my portfolio. If we get an end of year rally, I'll be taking profits more aggressively than I initially planned at that level. Not 100% out of the market, but going to slash down those altcoin bags big time. Also, avoiding any more leverage in my portfolio. Lark, come on. No more leverage. Focus on preserving capital here, okay? Need to get that tattooed on my arm or something. Anyway, aside from crypto, also looking at other investments. Long term, that's the big plan. Anyway, get money out of crypto and more into other stuff until it's only maybe 10 or 20% of my net worth, not the uncomfortably large percentage that it is right now. Whether or not we get a recession, I'll still keep waiting for those bargain prices to fill my bags, thinking long term. Crypto's not going anywhere, okay? Because you have to remember, recessions, they come. They're a normal part of market cycles. And recessions, they also end. You just have to make sure that you and your portfolio can survive it. Thanks for watching.